Hello, everybody. Just going to wait till a few more people get joined, but just wanted to start the webinar. Everyone can see we're here, and if you hold tight for 2 or 3 minutes, we're going to kick it off shortly. Okay, I think we've got about 14 people here, so I'll start my introduction. I'll go slowly. Bear with me. I'll try to keep myself from speaking too quickly. It's a bad habit. But yeah, thanks everybody for joining. I'm delighted to have you here for this webinar on the paradigm shift, what lies ahead for crypto ETFs as we head into 2025. It's been a real seminal year for crypto and crypto regulation, even if it might not seem like it in the US. Has kind of moved forward massively this year with the introduction of Bitcoin ETFs in January, and then with Ethereum following July. And now that we've got the US election out of the way, looks like there's more change coming. So I've got great guests to get into these topics with you. So I'll introduce Eric Pollackov, Global Head of ETF Capital Markets at Invesco. We've got Will Kai, who's MD, Managing Director of Indices here at Kaiko. And last but not least, we've got Marco Antonio, who's co-founder of Vinter, a Kaiko company. So Eric, I'll hand it off to you. Just give a little elevator pitch for yourself.
Sure. So been in ETFs for over 20 plus years now, and I run a global team that really deals with the ET part of the ETF acronym, the exchange traded part of it, and making sure that the client experience is a positive one for the Invesco ETF suite, which is just under $800 billion US globally. So that's my 2 cents.
Well, great to have you here. And Will, do you want to take us away next?
Yeah, I'll go next. My name is Will. I look after the benchmark rates and index business here at Kaiko. My background is a trader, mostly 20 plus years in New York with JP Morgan, initially exotic derivatives and then in commodity indices. But I also had, between JP Morgan and Kaiko, had a small ETF startup, and I had a lot of experience working with the SEC regarding crypto products.
Great. And Marco?
Hello, everyone. My name is Marco Antonio Poblete. I'm one of the 3 founders of Vinter. We founded it about 5 years ago and grew to become the largest crypto index provider for asset managers in Europe. My background is legal. I'm a lawyer. I used to work in capital markets and regulatory, and been focusing on the ETF market for quite some years now.
Great. And quick intro on me. Adam McCarthy. I'm the research analyst here at Kaiko. I've been here since about April, working on a lot of the kind of intersection of traditional finance and crypto, decentralized finance, which now includes wallet data, blockchain analytics, and ETFs, obviously. So, excited to be here with a great panel. And just at the top of the call, I'll say if you have any questions throughout, please just drop them in the chat, and we'll kind of keep a track of them at the end. And hopefully we'll have 10-15 minutes to go through all those. So I won't speak too much, but I guess I'll just kind of put a roadmap for what we're going to go through here today. It's been a huge year for regulation, as I said earlier. Bitcoin ETFs are probably the biggest regulatory thing that's happened in crypto to date. and it was, came about from an unlikely source in Gary Gensler's SEC. That's all changed now. We've got a new chair coming in January, with Paul Aikens coming in, who's seen as sort of a crypto advocate by some in the media. But I guess, with that in mind, I saw a good Chinese saying was, there's no eternal enemy. I guess crypto and SEC have been enemies over the last few years. Do you guys, I guess we'll start off with you, Marco. Do you think that that's going to change now with the regime change? Like in a broad sense, can we expect the SEC and crypto to sort of work more hand in hand rather than kind of the regulation by enforcement that we saw?
Yeah, no, absolutely. I think this new SEC leadership signals a major crypto policy shift. Paul Atkins, former commissioner, he will likely introduce a streamlined ETF approval process, clear custody rules, while still maintaining core protections. The focus will probably move away from blanket rejections to more of a risk-based evaluation per product. And I think this will lead to ETF issuers gain freedom to develop market-driven products with a reduced regulatory constraint. And the result of it will be more innovation, faster approvals, clearer standards across crypto products.
Nice. And I guess, Eric, from your side, you're in the States, you're based, you've got a little bit more skin in the game. Then, what do you see then as the regime change, and what does it mean? What does this mean for crypto ETFs in particular?
What I finally see for the first time in at least 4 years is optimism in the industry. Smiles, for lack of a better term. I mean, it has been such a drawn out fight with the current regime in DC, in the United States, to get anything progressive around rules. Forget about products. What about just rules, right? And just basic regulations that can help define a path for an asset manager like myself to build something more innovative than what we've been allowed to do. And I haven't seen optimism, even in Father's Day of 2023, when we got a call from my attorney saying that, hey, we got to start building this product for a Bitcoin ETF. So that was optimism for a second, but then it quickly got, blown out by the Gary Gensler-led SEC. And that being said, it's just nice to be excited in the industry. Clearly, 65,000 to 100,000 in Bitcoin alone is pure optimism, right? And kind of speculation. So I think it's just good to kind of be back, for lack of a better term. And I think that as an asset manager that manages over $800 billion in ETF assets, the innovation is exciting for the first time in many years. And I think that's really where I think a lot of asset managers, particularly that manage ETFs specifically, are really looking forward to the future.
Nice. And I guess you've kind of come from a unique spot. You had, like, as you said, you're previously worked on launching ETFs related to crypto, and now you're working on the index side. So I guess, what's your 2 cents on that? Like Marco talked about the risk-based approach and kind of changing how they view it. And then Eric's obviously the optimism is great. Like, how do you see things changing now?
Yeah, no, I love the Eric comment about optimism. I mean, to me, it's really, hopefully, it's back to the basics. And at the SEC, they're tasked to protect investors, but they shouldn't be a merit-based regulator. They don't approve saying this asset is good or bad for investors. They're tasked to making sure all the risks are disclosed to investors. The investor can make a proper choice. So the current administration, the Gensler, really seem to be gone off that mandate or path. It's really a merit, saying crypto does not have the merit to do this and that, to be this kind of investment vehicle or that. So I really hope and I think it will under Paul Atkins, that the SEC will back to what their original mandate and purpose is, to protect our investors. And look, I think Paul Atkins is a great nomination. He's, as you mentioned, he's a prior commissioner, and some of the current commissioner were part of his legal staff when he was commissioner at the SEC. So he has great connections. He knows the crypto industry. Though I do want to say that it won't happen overnight, the changes. But I think what he's not coming in to tear down the house of the SEC. I think changes will happen gradually but surely under his leadership.
Sorry, can you guys still hear me? I'm having some connection issues.
Yep.
Yes.
I can hear you.
My connection was lost there. Sorry, no, that's very interesting, Will. I think when you say like back to basics and the changes, I guess I'm interested in, like, we saw how the process worked for these ETFs that currently got approved. We had the kind of grayscale case was like a huge moment, but that created a sort of rule, like in a sense of its own, where it was, if you had the futures market, that surveying agreement. Do you think that's going to continue, Will, or we're going to evolve beyond that now?
I think things will evolve. Even in the Bitcoin approval process, my understanding is a lot of people might not be aware, but some of the benchmark the goalposts had been changed. Before, it was a very strict prior set bar. You need to have a information sharing agreement with a regulated market of significant size, and that rule or precedent was passed from prior cases. But when the ETFs were approved, the rules were slightly changed and loosened to be as long as the prices for crypto had a high correlation with the with the futures market, then it would have been okay. So that goal shifting did happen and potentially will happen going forward as well. So I wouldn't be surprised if the rules slightly changed to accommodate some of the ETF products that ETF issuers are thinking about or trying to list.
Eric, how do you see it from your point of view?
Yeah, I agree with everything Will said. I mean, again, I go back to optimism and progressive thought processes around protections for investors, as opposed to just sheer, banging the gavel, so to speak, and stating no. And I think that if Atkins gets admitted, which approved, I think that there will be a more thoughtful process on how to regulate either whether it's an exchange traded fund, a closed end fund, a private fund that can hold things that are not futures based or have futures based on them. That seems like a pretty arbitrary type of decision that was made with regards to Bitcoin and Ethereum, but nonetheless, that's where we stand today. Hopefully, that's not the case going forward.
How do you feel about that, Marco? Does that make sense?
Yeah, that makes absolutely sense.
Do you think it's going to change?
I think that, like, when it comes to the approval process, it's going to be much more streamlined. I mean, the SEC is anticipated to approve a wide array of digital assets, including multi-asset, cross-assets. And this will open up for ETF issuers who list ETF with baskets that investors have been asking for a long time. Because on the Gensler, their valuation criteria was quite different. They looked at market surveillance capabilities, market manipulation, custody arrangements, and pricing mechanisms. And when it came to pricing mechanisms in particular, they were quite contingent on the CME. They relied heavily on the regulated futures market for crypto ETF approvals, using their surveillance systems and price correlation as key criteria. And Gensler's previous ties to CME also raised some conflict of interest concerns during his time. So I think Paul Atkins is likely to implement more of a broad evaluation criteria here, reducing the importance of CME, which suggests a more diverse pricing method and also surveillance options ahead.
Yeah, if I may add a bit more, just thinking about it is, currently the ETF review process is very much centered on commodity being crypto or Bitcoin ETH being commodity. But when we need the clarity between commodity versus security on some of the other tokens, which I assume some tokens would be securities, that opens up another different approval path. Instead of a 33 Act fund, it could be a 40 Act fund, a different approval process with different divisions, the SEC. So we can see new developments there. And in my mind, all this will snowball as more of these products become building blocks that are approved by the SEC, then the higher level, more complex and more interesting products can be built on top of these approved securities already. So I think we'll really see a snowball effect. And those hopefully will be already within the framework of SEC approvals. So it can, we'll see a snowball effect of more and more products getting approved and a broader array of crypto products in the coming years.
Yeah, and I thought about some of the applications that we're seeing currently. Like we've already seen some applications for ETF investing in a broader range of cryptos. Eric, do you think that there is appetite for some of these investments? Or what would be those benefits?
Yeah, absolutely. And I think, a couple other things, right? 2 years ago, Bitcoin was an 80 vol type of asset class. It's now under 50 vol, right? So the volatility has come in. What I've seen in the US specifically on the ETF industry over the last 5 years, since 6C11, which is the ETF rule in 2019 that was passed, is this huge change and shift towards actively managed ETFs. Yeah. A lot of it has to do with either yield generation or downside protection. Now, if you think about Bitcoin and lowering the volatility somehow, giving downside protection since its huge run up this year alone, and potentially offering yield that's greater than, SOFR right now, I think is where the future is going. And I really see that from an ETF industry perspective. Some of this has already been filed for, right? And it's going to come. And I think that's going to be another boon, not only to the price of crypto and Bitcoin specifically, but to investors and kind of making sure that even retail investors have access not only to physical Bitcoin, but to the protections that asset managers can help build, help them build in a regulated security, as opposed to calling up a desk at one of the large US banks and asking for this type of security to be built for you and you getting charged 175 basis points. So that's where I think the puck is going. Sorry to use a hockey analogy for my Canadian and non-US friends, but I think that's where we're going to see real innovation. Clearly, the diversified basket seems low-hanging fruit. There's no doubt about that. But really, how do we build in taking out some of the volatility, giving some downside protection, and offering better yield than currently is available? That's where I think we're going to be going.
Yeah, Will, I think that's an interesting area to bring you in, because I remember you were telling me initially your original idea for a Bitcoin ETF a few years ago was to rotate between holding spot Bitcoin and was it maybe having cash or something else. So I guess you're the kind of expert here on sort of getting more exciting, more exotic products. Like, what's your take on that?
Yeah, I mean, for us, Mark and I in the indexing space, this currently it's just the basic products, right? I mean, we are to Eric as well. I mean, I'm salivating to wait for the days where we can build these more complex products within our indices and benchmarks, whether it's vol related or we could look at other interesting factor strategies that we can do for crypto. Maybe it's too early, but sure. And I think the market will move towards there. In my mind, crypto, sure, it has its own characteristics and differences, but probably go through the similar stage of complexity, similar to other asset classes. For example, commodity. First, you got single assets,
sure,
something easy, and then you got baskets, and then you got vol products, and then you get very much structured product. So I'm very excited to see this progression to happen and more traditional players come in, and whether it's the changes at SEC or CFTC or the other government organizations, I have very optimistic to put in Eric's description of the coming years with the changes that's likely coming.
Nice.
And let me just add. Sorry, Adam. I just want to. I mean, if you think about credit, in an ETF wrapper, originally it was just this broad-based index credit ETF that's still out there to this day, 20 plus years old, billions of dollars in there. What's happened there? We've as an industry, we've divided it by credit quality, we've divided by duration, we've divided by industry, right? You can buy a specific industry credit ETF now. So I think you're going to see the same exact thing, to Will's point. is going to evolve with the cryptocurrency world, and it's really exciting, like I said, and optimistic.
I guess the over across the pond on the States, it's all about optimism looking forward. But Marco, you've had a lot of experience working with firms in Europe who've already launched a lot of products that we might start to see iterations of those in the US soon. So like, I'm interested in your take on these and the kind of the benefits and diversification benefits you've seen firsthand in your experience, and like what excites you.
Yeah, no. So first of all, it depends from my investor perspective. It's the diversification case, getting better risk-adjusted return, not having the exposure to one single asset. But when it comes to ETF issuer, at one point you have just a number of ETF issuers that can provide the same product before you get price compression and a race to the bottom. And then you have to start standing out. And the only way to stand out is to provide something different, provide a narrative, provide the reason why people should invest in your product rather than, the other guy across the streets. And one of the key things here is that if you have an ETF which has, might be a multi-asset ETF, might be a factor-based multi-asset ETF, might be a thematic ETF, might be a cross-asset ETF, but it does something different, and you can go to your investors, explain why this exists, why they should consider this, and why this makes sense for you as an ETF issuer, why you uniquely positioned to create this. And the fun thing of this is not that the answer is the same for every ETF issuer. Some ETF issuers will not be suitable for certain products, to list certain products, and shouldn't. It's going to be depending on what's your thesis, what's your product pipeline, who are you targeting, who are your LPs, and with that we're going to see a wider range. So as I said a few weeks ago, it's like we're looking more at innovation rather than regulation now. We're looking at trying to see what does the market need rather than trying to predict what enforcement is going to come from the SEC. And this is actually also according to one of the core legal principles that exist of predictability. We're getting predictability in markets now. We can predict what's going to happen, and because we can predict it, we can also start planning for the future and these new products. And I'm sure there's going to be a bit of a rush to some of them, but over time, I see that it's going to mature and develop similarly to us done, for instance, in the European ETP market, which has a lot of multi-asset products, but with the obviously increased flows in the US, that's gonna drive adoption massively.
Yeah, and like I guess the game changer in the US for the flows that we saw, it's like, I might be a bit naive here, but I thought that the big push drive for Bitcoin ETFs was that sort of, we've seen it in the data and the basis trade happening between CME Bitcoin futures and buying spot, and like ETH didn't take off initially as quickly, but then we've seen a uptick in the volume and the open interest on CME ETH futures as well. So like, does that create a roadblock, Eric, for like these different products in the US, or do you think they can complement these mixed basket or Solana, or having a dual Bitcoin ETH? There's their complements there, qualities that work together.
Yeah, I mean, clearly, I come from the sell side originally as I started my career in the ETF landscape, and was a trader, and clearly the arbitrage mechanism is somewhat a science, but more than often an art form. So you need to have the infrastructure to transact in something that doesn't have a correlated asset, such as a future or an option listed on it. So if you are looking at potentially Solana or Polkadot or anything in the other altcoin space, you've got to be good at how you transact in the physical, right? So if you're trading an ETF that's holding Solana, how do you hedge yourself, right? I mean, listen, there are other art forms to do this. You can use S&P 500 futures and just do it notional transactions and unwind, at the end of the day. But like ultimately, it definitely helps, right? The ecosphere of liquidity with futures on Bitcoin, futures on ETFs of Bitcoin, options of futures, options of physical, options of the ETF. Like, you've got all these different ways to hedge Bitcoin as a liquidity provider, which is great for investors because that helps reduce costs overall. But when you start moving outside ETH and Bitcoin into other coins, you need to kind of figure out what that art form feels like, what your balance sheet looks like, and how you think about hedging the risk that you're taking on if you're trading an ETF that holds something that doesn't have, those options, options as in other things, other correlated assets to transact in.
Yeah, and of course we've just got the Bitcoin ETF options only recently. So I guess with these other newer applications, I'm probably going a bit off piste here, but are we going to see that change as well? Do you guys think? Because there's been a lot of optimism. Like if we see a Solana ETF launch, could we see the options launch a week after? Could we see that all change? What do you think, Will? Like, is it gonna? It's all moving that way that we might start getting this wider investable universe of products come as a whole together. So rather than just having a spot Sol ETF, everything can start working in harmony, and you can get those products available so people can hedge properly, and there's more liquidity.
Yeah, I think so. But to be mindful, it won't be overnight. The Paul Atkins SEC, it will follow the rules and regulations and the framework that's already put in. For example, Solana, if Solana spot ETF gets approved, the option's not going to happen a day after. It has to go through the same the regulatory process and framework that's in existence. But I think the process will be smoother. The SEC will engage with the different players, potentially giving them a heads up or what this role potentially look like, or their concerns. A lot more of a collaborative SEC rather than kind of bashing heads and trying to figure out what squeeze through what might work. So I think I'm pretty optimistic. And another point is just looking a bit outside the SEC. I think it will be a coordinated government effort, and hopefully, if President Trump continues to push towards this effort, and the majority Republican-controlled Congress has the ability to push through, I think overall framework, regulatory or legal framework, will be very useful to give more clarity to what Marco had mentioned before, more clarity to all the players, whether it's corporates, whether it's banks. That would be huge for banks to feel more comfortable to be in the crypto space. All that will really help. Coming back to the ETF space, to really drive through the product approvals and innovation for next year and the years after.
Yeah.
Adam, I just go back to one thing? Sorry. I want to make sure it's clear on how options are listed on stocks and ETFs currently in the United States. It is sell-side demanded. So that means the trading firms out there can ask the listing exchanges such as the CBOE or NASDAQ to list options on a stock or an ETF. For Bitcoin and anything going down in the cryptocurrency space, permission needs to be granted by the SEC. That's not the norm. So my hope is, and I talked about optimism, is that under an Atkins administration, that there doesn't even need to be a question and a delay for an option to be listed on an exchange-traded fund that holds Solana or Polkadot or whatever the case may be. Yeah. That's where I want to see the puck go. Again, sorry about my hockey references here, but I think that's ultimately where regulatory conversations can be progressed to a place where it's not about asking permission anymore. It's about innovation in a thoughtful way that makes sense to investors. And I think that's hopefully where we can get this industry going.
And that comes back as well, doesn't it? Because I was looking at somewhere as well, because Bitcoin falls between a commodity ETF, and if we're launching other ones that might be classified as securities, you have to get SEC, CFTC, and then the clearing commission as well. So it's even trickier. So you're saying, but with typically it's actually a lot simpler. It's just a case of CBOE going to putting an application and launch these, and it can happen much more streamlined.
Yeah.
So
hopefully
this is the new era we're kind of heading into. And I guess if we want to move beyond regulation right now, maybe look more at our bread and butter here for Marco and Will, which is the benchmarks and the kind of the foundation for success, I guess, for the ETFs. When we move beyond Bitcoin and ETH, we saw last week with Bitcoin reaching 100K, we were showing the price discrepancies across different exchanges is still huge, even once they're constituent exchanges for these ETFs. Does it get more difficult now still, further out that risk curve? If you're pricing a Solana ETF, if you're pricing a HBAR ETF, what's the difficulty like along that scale, Marco?
Yeah, of course. So for the major coins in Bitcoin, ETH, there's high liquidity that enables efficient trading, accurate pricing. For altcoins, there is limited volume. It creates a wider spread, high volatility, a significant slippage risk, and those market dynamics, they challenge altcoin ETF operations. So small trades trigger substantial price moves, limited pricing data hampers valuation accuracy, and low liquidity delays trade execution. So stablecoin market shifts also directly impact altcoin stability. Like liquidity for altcoins differ fundamentally from BTC or ETH markets. Like if you look at spot markets, they do show adequate depth for instance, Solana, Cardano on some major exchanges. The primary liquidity indicators is that we look at 24-hour trading volumes. They're consistently above $500 million. There's a tight bid-ask spread on the tier one exchanges. There's multiple active market makers, but there are some challenges when we go down the asset list. We're gonna go down to the top 10, the top 20, or even further than that. We're gonna start seeing these issues, and the bottom line is that we're no longer looking at getting approved, as Eric says. We're not looking for approval to get allowed to get in here, but we're actually looking at operational efficiency. We're looking at, does this make sense to list in an ETF? And as an index provider, it makes sense for us to also think about this when we are creating the indices. It is a listable index, it is a quotable index, it is a hedgeable index. Is this something that's actually supported by the different market participants, the custodians, the market makers, the listing venues? Will they approve it based on those criteria rather than some arbitrary rules?
Yeah, Will, I'll let you jump in there, I think, because you look like you have something to say.
Yeah, and to add to Marco, we as index provider, benchmark providers, a lot of it won't be new to us in the sense that, look, Marco and the Vinter has been operating in Europe ETP markets in a way ahead of the U.S. regulated space. We've been providing benchmark to the likes like 21 shares on basket indices and these are live products. Some of the challenges that Marco pointed out to, yes, but we have thought about and tackled to create these benchmarks on tokens that potentially has less liquidity. And for Kaiko specifically, in the past years, our benchmark are also used in exchanges across the world. For example, for SIBO in the US, but also for these 24/7 perp markets. For example, we support Gemini, not the spot market, but their perps market in APAC, and they list a ton of different pairs. So our benchmark are already catering to that need and having the robust methodology, transparent and robust methodology to deal with these illiquid pairs. Sometimes, to what Marco suggested, and it's not even in USD, but in USDT, USDC. But we have ways of monitoring these the liquidities there and have mechanisms within our methodology to potentially deal with issues on these less liquid tokens.
Interesting. And Eric, can I bring you in on this? I was wondering, like, what do you look for then in an index partner, and what's the kind of important things you see? Because in this new space like crypto, it's different, it's difficult to price. So we'll go what you see.
Yeah. There's a couple things, and there's a question in the chat as well. Talk about the independence of index providers versus asset managers. So let me start with yours, Adam, first. I mean, we look for, a rules-based methodology, a transparent kind of pricing, thought process, and in the U.S. we think about things like GAAP, right? Like GAAP compliance is a big kind of thought process for us with regards to our books and records and our board and the things that we need to report to investors. Those are the types of things that are important. In terms of the independence question, I mean, I look at it this way. Just in the ETF wrapper, so let's just stay there. 231 products in the US. I've got about 20%, 15 to 20% are self-indexed, means that it's an Invesco run index that we manage against. And then we've got about 20 plus different index provider partners. And when I think about the ETF wrapper and indexes, I look at I use the restaurant thought process because I put myself through college waiting tables. But like you look at the author of the index is basically, the one that provides a recipe to my PMs, who are then the chefs, right? And they need to cook that recipe in a way that's most optimal to what the author of the recipe stated. And that's based upon things like flows, assets under management, type of asset that's being covered, so on and so forth. That all being said, the investors are the ones that come to the table and sit down at my restaurant and then buy, eat the author's my PM's recipe. So that's sort of the point I'm trying to make here, is that independence, it's important, not uber important, but it's really more about that transparency, who's writing, that recipe, and then how we manage it, I think, are the more important parts for investors specifically.
Interesting. Marco or Will, I was wondering if you guys, I like that analogy. I've not heard it before, but if you guys are on that, like, I mean, from your point of view, and how do you find writing that recipe, or how do you find that helps, like, what's the message that you get across to issuers, Marco, that like kind of resonates the most, and why they should choose Kaiko or Vinter or with us?
Yeah, so I think it's also a bit different depending on the market you're in. So in the EU, we have something called the EU benchmarks regulation, which is based on IOSCO principles in the US. And the question of conflicts of interest is sort of a classic problem in financial markets, and legal scholars have been writing about it for decades. And there is an inherent risk. Company controls the value of a number and also directly benefits from the performance of that number. So financial indices, they play a vital role, of course, in financial markets, and issues of financial instruments. I would say that they would benefit in certain situations from having a self-indexed index, in some situations from having an outsourced index, unless there is a regulation that tells them that they have to do it all the time. And I would say particularly if the index is quite complex. So the more complex the index is, the more room for discretion there is, the more room for manipulation of the index there is. And that's when we get into situations that we saw, for instance, with the LIBOR scandal. So I think that when we're looking at these single asset or just 2-3 assets in one index, the risk isn't as high as when we're looking at more complex indices, which maybe combine multiple factors as well, which maybe have a degree of discretion even in them. And then we're starting to see something that could get manipulated. And the larger the AUM, the more the market matures, the more important it becomes with separating those two roles, I think.
Nice. I'll let you kind of close it out there, Will. Do you have anything to add on that?
Yeah, I know the question, at least in the chat, is about independence between index providers and ETF issuers. But here in our space, we also deal with a similar independence issue between exchanges and ownership of index providers. For example, CF Benchmark is owned by Kraken, CoinDesk Indices is owned by Bullish. So we have a similar potential conflict interest between the data that's being used and how indices are constructed, and when potentially it's a conflict to the parent company, the exchange. So at Kaiko, we tried so far to be as independent as possible, to not necessarily to say those setups don't work, but at least we can be consciously to be free to that conflict, and without to have to consciously really deal with it and set up Chinese walls and so forth. So we as the space consolidate, I think this will be more and more important to have players that has less or free of conflict interest issues than players that don't.
Yeah, because we saw that, didn't we, Will, with if you're a constituent exchange, that's for these benchmarks, there was the volume obviously coalesces for a lot of crypto exchanges around US hours, but there was even an uptick during that kind of fixing window if you're one of these constituent exchanges. So there was like a volume incentive there for these exchanges. I wonder, like, does that happen in broader traditional markets, Eric, as well? Like, is there as much weight put on the indexing, or is this just kind of a symptom of crypto's kind of youth in that we're to focus on it so much?
So, yeah, Adam, let me be a cynic here, and this is just Eric Pollackov's opinion. There is more front running in index-based products than there is in anything else, right? There's an art form towards it. Prior to, and the index providers have done a really good job over the course of at least my career of mitigating some of that. But I mean, if you think about like the Russell rebalance 10, 15 years ago, that was such transactional trading opportunity for the sell side to make real money there, betting on stocks that are going in and stocks that are coming out. With all that being said, I think crypto is a little bit different because there are different methodologies, right? Not everybody's the last hour in the U.S. Some are, some aren't. CF Benchmarks is. We're not, for example. So we don't deal with those types of things. But yeah, I mean, I think to Marco's point, independence and kind of methodology and transparency, all these things come into play, whether it's crypto or stocks or bonds. And I think that's really how the relationship between an index provider and asset manager, can be beneficial to end investors.
Nice. I think we've got through kind of the questions I had for everyone. I see some people are typing in the chat still. So I guess before we kick off the Q&A, so if anyone has questions now, they can drop them into the chat, start queuing them up. But I guess my final question would be, what's the one big policy shift that you guys would like to see? We've talked about ETFs, talked about crypto, kind of the approach. Like, is there any one thing on your kind of Christmas wish list heading into 2025? Will, do you want to kick us off?
Sure. That's one is a big ask. So as I think I alluded to, what I'm really hoping for is a coordinated effort across different federal agencies and also the Congress to really have a framework of regulation for crypto, whether it's commodity versus security or a framework for stable coins, to really bring crypto into the regulatory framework and the financial space. That will bring a lot of clarity, which will foster adoption and innovation. So no one big policy, but really a major shift of a coordinated change in the regulatory environment for the U.S. in 2025.
Nice. Marco, I guess I might be putting the horse in front of the cart there. I think it's one thing. You've kind of answered it well, Will, but what do you think, Marco? Can you narrow it down to one?
I would say clarity, like clear regulatory definitions across various digital assets, clear standardizations, predictability. That's what I'm hoping for.
Eric, anything? What stocking filler are you looking for in terms of policy shift?
I think Will and Marco nailed it. Clarity, transparency. A clear framework. Like these are. It befuddles me sometimes that some of this is so like low-hanging fruit is not even the right term here. It just makes sense, right? As an investor in the United States, to be hammered by this current administration has just been nothing but sheer awfulness. And I really, really look forward to a framework that my firm and others, my competitors, can all work in, that makes sense to help investors reach their goals in the cryptocurrency space.
Nice. I guess I'll keep with you, Eric, because we got a question in the chat from Jacob at Vinter, and he said, you mentioned that we might get a world where demand and not regulators dictate what products we're offering. He's kind of wondering, when do you think that's going to happen? How soon?
So let me take a step back, right? Again, I'm an ETF guy, tried and true. We're now approaching almost 4,000 exchange-traded funds. Is there a demand for all 4,000? Probably not. Today, and I'll pat myself on the back, we launched the largest seeded ETF ever globally at $2.5 billion US. That was because of a client demand, right? I think the industry going forward, particularly in ETFs, because they needed to be marketed properly, sold properly, and traded properly, that client demand is going to have to, take the wheat from the shaft, right, so to speak. And I think that's where the industry is going to have to go, whether it's cryptocurrencies, equities, commodities, futures, options, structured products. If it's going to be wrapped in an ETF wrapper, ultimately client demand is going to drive the success. And I think that's sort of becoming much more commonplace, and people are understanding this now. Again, post 6C11, barriers of entry to get into the ETF business drastically lowered, cheaper than ever now to get in, right? But the barriers to success infinitely higher now. And client demand will actually drive product development in any type of asset class, and particularly cryptocurrencies for sure.
Interesting. So I guess we must be seeing some of that demand if we're getting these applications from Mixbasket and Dual Asset and things like that from others in the market. So it's interesting to see that how that plays out early next year. I guess I have another question, but if anyone in the chat or in the room has anything, they can please feel free to drop it in. Otherwise, I'll move on to my final question for everyone, which is, so if someone jumps in and asks a question, you guys have a little bit longer to think about it. But basically, for all three of you, if Bitcoin ETFs were the theme in 2024, what do you think what's going to drive the narrative in 2025? Do you have any thoughts, Will? We've had the year of Bitcoin ETFs, I think. And Matt, what's 2025 hold?
Interesting. It's look, I think what's exciting and optimistic about it is that the possibility could be endless. It's not Solana ETF. Let's put it out there, right? It's not that. I have much more bigger hopes than what's possible in 2025 versus what has happened in the past 4 years or in 2024. So I would like to be pleasantly surprised on what's possible. So whether it's a lot more single ETFs or some baskets or some options, maybe we can even be more adventurous into other things. So I hope the sky. I don't want to get too ahead of myself. As I said before, things will take time, but I hope it's in the next 4 years, the sky could be the limit and really opening up the U.S. space for the investors, for the retail investors and institutional investors as all, in terms of regulated products that's possible.
Do you agree, Marco, or have you got a different take on what's going to drive the narrative?
I think the obvious answer is, of course, we're going to see multi-asset, we're going to see more assets. But I think we should look beyond just which other products are going to be listed. How's this going to affect the entire ecosystem? I think we're going to see a few companies like Circle, Kraken maybe going public. We might get some strategic reserves. We're talking about having a Bitcoin strategic reserve. We might have an intersection between AI and crypto that hasn't really been fully explored. I think like the convergence of those two. We're obviously going to get clearer frameworks. That's what I was wishing for, at least, and maybe even some global standards, because this is a global asset and this is traded 24/7. So maybe it makes sense to not only see it from a US perspective, but maybe the US could lead the way here. And finally, I think that maybe some Web3 adoption, like the growth of the decentralized internet, is still set to transform, and I think this is something that could come for the future. So those are some of the outlooks that could come due to this that aren't directly related or related to ETFs.
Yeah, sorry. So it doesn't have to be just ETF related, I guess. What do you think, Eric? Is there beyond ETFs what's going to drive sentiment in crypto?
I'm not sure it's crypto, but it's more on the blockchain, in my opinion. Tokenization of real world assets, I think, will reignite itself to the extent, and maybe at the behest of the exchange traded fund. But I think that's really where the technology will bring us. I don't know if it's 2025, but I just think that ultimately settlement of things like a piece of artwork, a hotel, I think that's where the blockchain technology will kind of be better for retail investors, and I think that's where again, I'll go back to hockey. That's where I think the puck's going.
Don't worry, I don't mind the hockey references. I'm a Leafs fan, so I get them just about. But we actually got 2 more questions from the chat, and I'd like to touch on these because they're related to the current ETF, Bitcoin and ETH, and basically, do we see changes those structures? Obviously, we never had staking with ETH initially in the US, and we didn't have in-kind create redeem with Bitcoin. So, on those 2 things, great questions from Lawrence and Peter. Do you think those change? Do we get in-kind cash creates? Do we get staking with ETH?
I think the low-hanging fruit for in-kind is yes. I think staking will take longer. And I think the real reason behind the latter question is because the educational process of teaching what staking is versus sec lending, which is what I think a lot of people not in the crypto industry kind of just equate it to, when it's not really the same thing. So I think that educational process will take much longer than I think the physical, because all of us, all 12 of us, have all proposed that physical in-kind creation redemption process, much like gold ETFs or platinum ETFs or silver ETFs that hold physical bars. It's the same concept here, and I think it could be much more a lower hanging fruit type of conversation.
Yeah, Will, I think you kind of educated me on this the other day, because I had that securities lending kind of confusion that I thought staking could work simply as that. But I guess you pointed out to me some of the issues with why it's not as simple, I guess, with the staking and unstaking.
Yeah, first, but I'll talk about staking in a second. On regarding in kind, I mean, to me, that was such a last minute move by the SEC, forcing everyone to do cash, where in kind is so much more efficient, could be tax efficient. I really hope that gets sorted out sooner than later. And with it's been a year plus, and as far as I know, the creation redemption process, the trading process has been pretty smooth. No obvious signs of manipulation or craziness. I'm not sure what exactly the SEC was really worried about, or was there anything specific. But to me, the operations of the Bitcoin ETF was such large AUM now, and the trading operations around creation and redemption has been rather smooth. And hopefully this will get comfort to the new SEC coming in, that this should convert to allow both in-kind and cash. Regarding staking, yeah, I would love to have, I think, staking for ETPs, even ETFs, even for us as index providers. That's a very native crypto thing, right? I mean, it's to have ETH and without staking. It's like, I'm not sure what the analogy is. It's just not you're not serving investors properly. You've given this product, but you said, no, you can't have the extra yield. But there are to what you suggested, as to the conversation I had with Eric early this year as well, there are complications around staking regarding redemptions and the timing of unstaking, to that could potentially cause issues with daily creation and redemption, especially redemptions. But I've been pushing a narrative, and this could be again, let's see if it happens, is in crypto, there's liquid staking. Potentially instead of ETH, it could be a staked ETH or STEETH product that you can maybe get around that issue by having a STEETH token rather than Ethereum token, where the staking is kind of built in. Obviously, introduce a different set of problems. You can have DPEG and whatnot, but it's exciting for me to think of these solutions as possibilities with the new SEC coming in. So I think, people will look for solutions, and maybe it won't happen overnight, but it's possible in the new administration and new SEC.
Nice. And I guess you could in theory, you could have a mixed basket, ETH, staked ETH, and 80-20 split, and if that was creating the yield from the liquid staking, 20% of that fund or something. Or how does it work in Europe, Marco? Because you've worked on some of these.
Yes, you can utilize liquid staking tokens to provide immediate liquidity. Then you can have redemption flexibility while still earning the staking rewards. And you can also do that. You maintain a portion of the assets in a non-staked liquid form, so you ensure that funds are available to meet redemption demands promptly. And then, those are the two strategies that you could implement in the US as well, I think.
Nice. And again, I assume you're all for cash create, redeem as well, Marco, right?
Yes.
Have you got? Sorry, Eric, I cut you off. Did you have something to add?
No, the only thing I would also add is the ETF structure also allows for a line of credit, right? So if you get a run on redemptions and stuff is stuck in the queue that you're trying to pull back from being staked, you could extend that line of credit as well. We have it for a handful of our ETFs just in case too. Never tapped on it, but just again, throwing that out there as a solution.
Nice. Well, I think that wraps up all the questions in the chat and my questions. So I'll thank you guys for your attendance. Thanks so much, Eric, for coming along, and Marco and Will. I'll see you guys soon. So just want to thank everyone. Cheers to all the attendees. If you want to get in touch with anyone who's on the panel today, if any further questions, please just reach out to us. We'll be happy to facilitate.
Thank you very much.
Great. Thank you. Bye, everyone.
Thanks, Adam. Bye now.
Bye.